The financial world is largely asleep, dreaming of artificial intelligence and stock market highs, oblivious to the tectonic shift occurring right beneath its feet in the precious metals market. While eyes are fixed on digital illusions, the bedrock of real money, physical silver, is quietly disappearing from the world's most secure vaults at an unprecedented rate. Today, we have concrete, undeniable evidence that the long-predicted silver supply squeeze has officially begun, signaling a massive paradigm shift for global finance. This isn't speculation or internet rumor. The confirmation comes directly from the United States government through an unprecedented announcement by the U.S. Mint. I have obtained an official email sent to major distributors stating that the U.S. Mint has suspended all further sales of its prestigious Morgan and Peace silver dollars for the year. The stated reason is shocking in its simplicity. They have completely run out of the silver blanks necessary to mint these iconic American coins. Remember, the U.S. Mint is legally mandated by Congress to produce silver eagles to meet public demand, yet they are failing this basic requirement. They have been rationing sales for a long time, but a complete suspension due to a lack of raw materials is a massive escalation in this developing crisis. This mint breakdown is just the tip of the iceberg, the visible signal of a much deeper, systemic shortage roiling the global silver market. If the powerful United States government cannot source enough silver to mint its own currency, what chance does the average investor have when the panic truly starts? The mainstream financial media is ignoring this story, placating you with narratives of a soft landing while the physical foundations of the monetary system begin to crack. We must look beyond the headlines and understand the mechanics of this squeeze, which is rapidly draining physical inventory from key hubs like London and New York. This situation is eerily reminiscent of historical silver squeezes, but the scale of today's industrial demand and monetary printing makes this event unique. The paper price of silver on the COMEX is a carefully managed illusion, detached from the violent reality of physical supply and demand dynamics on the ground. While the paper price is suppressed, smart money and sovereigns are quietly accumulating every available ounce of physical metal before the rest of the world wakes up. The suspension at the U.S. Mint is the first domino to fall, a clear indicator that the physical constraints are finally overwhelming the paper manipulations. We need to analyze the data coming out of the London Bullion Market Association, because the situation across the Atlantic is even more dire than in Washington. London is the hub of global physical silver trading, and the inventory reports surfacing from their vaults are nothing short of terrifying for the banking establishment. When you peel back the layers of accounting tricks and leased metal, you realize the vaults are functionally empty of unencumbered silver available for delivery. The countdown has started, and the window of opportunity to secure your wealth with real, tangible assets is closing faster than anyone anticipated. To grasp the gravity of this crisis, look at the London vaults, which have hemorrhaged over 300 million ounces of silver in just the last 2 years. This isn't a gentle decline, it is a precipitous drop, taking inventory levels to their lowest point since accurate record-keeping began in 2016. The establishment wants you to believe the silver is merely rotating between owners, but the data indicates it is leaving the banking system entirely. Much of this metal is held in exchange-traded funds like SLV, which ostensibly hold silver for investors, but act as a supply reservoir for desperate industries. We are witnessing a phenomenon where silver is flowing out of these ETFs at a staggering pace, even when the price action suggests investors should be buying. This implies that the authorized participants, the big banks, are redeeming shares not to return cash to investors, but to extract physical bars to meet delivery demands elsewhere. The float, the actual amount of silver available for immediate sale and delivery, is shrinking rapidly, making the market incredibly fragile to any demand shock. On the COMEX in New York, the distinction between registered and eligible inventory is the key to understanding the depth of this deception. Eligible silver is merely metal stored in COMEX-approved vaults. It is not necessarily for sale and may be owned by long-term holders with no intention of selling. Registered silver, the stock actually available for delivery against futures contracts, has plummeted by over 70% since the squeeze began in early 2021. We are operating on razor-thin margins, where a single large entity standing for delivery could effectively break the exchange and force a force majeure event. While the supply side crumbles, the demand side is being turbocharged by global government mandates for a transition to green energy. You cannot build the green utopia promised by politicians without massive quantities of silver, the most conductive metal known to man. Solar panels, electric vehicles, and 5G infrastructure are not optional consumer goods. They are strategic imperatives for every major world power. The solar industry alone is consuming an ever-growing percentage of annual mining supply, and newer panel technologies require significantly more silver per unit. This creates a structural deficit that cannot be fixed by higher prices alone, as it takes a decade to bring a new silver mine from discovery to production. We are facing an inelastic supply colliding with an exponential demand curve, a classic economic setup for a violent upward price revaluation. Yet, the price remains suppressed, creating a massive disconnect that allows smart money to drain physical supplies at bargain basement prices. China has recognized this strategic vulnerability and has been aggressively importing silver, effectively cornering the market while the West sleeps. The Shanghai Gold Exchange is now trading silver at a significant premium over London and New York, acting as a giant vacuum sucking metal from the west to the east. This arbitrage opportunity creates a one-way valve where physical silver leaves the west, likely never to return, further tightening the domestic supply screw. Meanwhile, on the supply side, the major silver-producing nations like Mexico and Peru are facing declining yields and rising political instability. We have reached peak silver, where the easy-to-access deposits are exhausted, and miners must dig deeper to find lower-grade ore. The ore grades have collapsed over the last decade, meaning we must crush significantly more rock just to extract the same amount of metal. Combined with skyrocketing energy costs and stubborn inflation, the floor price required just to keep mines operational is rising aggressively. Critics often point to recycling as a savior, but they fail to understand that silver in modern electronics is microscopic and uneconomical to recover. Unlike gold, which is hoarded and preserved in vaults, silver is largely a consumable industrial metal that ends up in landfills, lost forever. This creates a permanent structural deficit that is mathematically impossible to resolve without a price explosion to incentivize new exploration. The current price suppression acts like a massive dam holding back a river. The pressure builds silently until the structure catastrophically fails. The bullion banks holding massive short positions are trapped. They must suppress the price to avoid bankruptcy, but this only encourages more physical drainage. It is the ultimate short squeeze setup, potentially dwarfing the volatility we saw with meme stocks, because silver is essential for modern civilization. Smart players like JP Morgan spent years accumulating the largest physical stockpile in history, effectively hedging themselves against the very crash they helped engineer. The moment the industrial users, companies like Tesla, Apple, or Samsung realize they might not get their delivery, panic buying will commence. These corporations are not price sensitive. They will pay any price to keep their assembly lines moving, bypassing the paper markets entirely. Governments can no longer intervene to smooth out supply shocks because strategic government silver stockpiles were foolishly sold off decades ago. We are seeing similar supply crunches in uranium and cocoa, where years of underinvestment led to sudden, violent price doublings. The timeline for this correction is accelerating as the unallocated account holders rush to convert their paper claims into physical metal. Unallocated silver is the banking world's greatest trick. It is essentially a fractional reserve scheme where multiple investors own the same ounce. When the music stops, there will only be one chair for every 100 people trying to sit down, leading to a default event. This is why having physical possession, metal in your hand, or a private vault is the only hedge against the counterparty risk inherent in the system. The current price suppression is a temporary anomaly. In economics, mathematics always defeats manipulation in the end. When the inevitable break happens, do not expect a polite, gradual climb. It will likely be an overnight revaluation that catches the world off guard. You could go to bed with silver at $30 and wake up to a market where no physical metal is available at any price. This is not fear-mongering. It is a sober analysis of logistical realities and the extreme fragility of modern supply chains. The U.S. Mint's unprecedented suspension is your canary in the coal mine, singing a final warning before the explosion occurs. History consistently demonstrates that during currency crises, tangible assets are the only lifeline capable of preserving purchasing power. We are rapidly moving toward a bipolar financial world where the East backs its currency with commodities, while the West drowns in unpayable debt. Silver remains the most accessible entry point for the average individual to effectively opt out of this failing fiat currency experiment. Do not wait for the mainstream financial news to tell you to buy. By that time, the premiums will be astronomical and inventory non-existent. The window of opportunity is closing, and the sold-out signs are already appearing at the highest levels of government mints. Your strategy should be simple and defensive. Acquire physical ounces, secure them outside the banking system, and hold for the long term. Ignore the daily volatility of the paper charts. They are psychological weapons designed to shake you out of your valuable position. Focus strictly on the dwindling vault numbers and the desperate, behind-the-scenes scramble by major industrial users. The greatest wealth transfer in history is currently underway, moving silently from those who hold paper promises to those who hold real things. This supply squeeze is not merely a possibility, it is a mathematical certainty simply waiting for the right catalyst to ignite. That catalyst is clearly here, the public admission by sovereign mints that they can no longer source the raw metal they need. Prepare yourself, protect your family, and secure your financial future while the price is still artificially low. The era of cheap, abundant silver is ending. The era of true price discovery and scarcity is about to begin. Do not be the investor left holding worthless paper contracts when the physical vaults are finally declared empty. The time to act is now, before the rest of the world wakes up to the reality of the shortage.